Hola, muy buenos días. Les habla Carles Gaju, gerente de distribución institucional, y en nombre de Vice les doy la bienvenida a nuestro webinar Perspectivas económicas y tendencias para el oro, junto a VanEck, donde nos presentarán una actualización de las tendencias de la industria del oro a nivel global, así como las perspectivas del mercado y las oportunidades de inversión que permite el ETF VanEck Gold Miners, en un portfolio diversificado. Hoy nos acompaña Imaru Casanova, analista senior de oro para las estrategias de recursos humanos y oro de VanEck, desde que se incorporó en 2011. Tiene más de 20 años de experiencia en finanzas y en la industria del oro y de recursos naturales. Vice y VanEck han trabajado juntos por más de 12 años, ofreciendo productos a clientes chilenos, como los ETFs, el ETF que vamos a ver hoy día. Y al final de la exposición, como siempre, tendremos tiempo para conversar con Imaru, por lo que pueden ir escribiendo sus preguntas en el chat y después la revisaremos junto a José Antonio. También al final de la presentación les vamos a mostrar un código QR para que lo puedan escanear y nos ayuden a contestar una breve encuesta. Para nosotros es muy importante conocer sus opiniones y así ir mejorando nuestros futuros webinars. Bienvenida, Imaru, te cedo la palabra y muchas gracias por estar con nosotros.
Hola, buenos días a todos. Gracias, Carles, por la introducción. Gracias por acompañarnos a los que están en línea. Es un placer estar aquí con ustedes. Como Carlos dijo, yo he estado con VanEck desde el 2011 y bueno, soy una de las encargadas del manejo de este portafolio. Hoy vamos a empezar con un resumen de cómo vemos el futuro del oro, del sector oro, y después seguiremos con el caso para los mineros y como Carlos dijo, tendremos también una oportunidad de hacer preguntas. Como fue planificado, la presentación la haré en inglés, pero quería darles la bienvenida en español. Y bueno, espero que aprendan bastante esta mañana. Vamos a empezar aquí con la primera parte de la introducción. Brevemente, no voy a pasar mucho tiempo en esto, pero brevemente quería simplemente introducir a la compañía y que ustedes vean más o menos la historia de la compañía. VanEck ha estado en este sector involucrado por muchos años. El fondo se lanzó en el 1968 y así que tenemos una larga trayectoria con oro. Esto simplemente da una overview de los assets under management for the company. You can see that we got about 56 billion in assets under management, and just to highlight, about 25 billion of that is in gold. Over 50 years of gold leadership, something we're very proud of. I think our fund, the International Investors Gold Fund, was the very first gold mutual fund in the United States and maybe globally. So again, gold is part of VanEck's DNA. And here is just, we want to just highlight the sort of 3 products that you can gain access to a gold mining strategy through. We've got the International Investors Gold Fund, the actively managed gold mining fund, which is the fund that I manage. And then we have the 2 ETFs, GDX and GDXJ as well. And let's just now get into the meat of it. The first slide here is a slide of the gold price, the historical gold price going back to 2008. You can see how beginning in 2016 we embarked in a new gold bull market. The trend, there's a clear break in that bear market trend that we were on from 2011 after hitting all-time highs through 2016. What really got the gold bull market started was the Fed starting to hike rates in 2016. At that time, I don't think it was perfectly clear that we were in a gold bull market. but because the gold price was range bound in that $1,300 to $1,400 range. And so it wasn't that obvious that we were at the beginning of a new gold bull market. But in 2019, when the Fed reversed course and started to lower rates, then that's when gold really took off. And of course, we were already in the longest expansion in US history. So we were due for a recession, basically. But obviously, the beginning of the COVID-19 pandemic accelerated that, and that's what really set gold higher in 2020. This chart is already a little outdated. We clearly crossed the $1,900 range and actually reached a high of 2,070 a few weeks ago. We did have a bit of a pullback, but the gold price is in that $1,900 to $2,000 range now. And we think that's where that old trend, that $1,300, $1,400 trend, we're not going back. There has a new trend, positive trend has been established. And so we have a very positive outlook for the gold price. In the next slide here, we want to put this bull market in context. So we're looking at other historical gold bull markets. And what you can see, the red line there is the current bull market. And it's sort of tracking that 2000s gold bull market. Often we get asked, you know, gold is up a bunch. Is this it? You know, are we late to the party, basically? And you can see here that we're not. We're sort of in the early innings of this bull market. This long bull markets can be long, and the gold price can strengthen quite a bit. The two lines there, the green, I guess green line and the navy line, are periods of where the gold prices are bull markets where the gold price was responding to inflationary pressures. Currently, we're in a deflationary environment. Gold really responds to both. It responds to systemic financial risk, but it is clear from those lines, that chart there, that in inflationary periods, gold really gets going, and you know, a 500% increase in those periods, it's possible. So while we're not having inflation yet, it is possible that inflation expectations will start to increase, and that could even lend more fuel to this gold bull market. In the next slide, at different points, there's different main drivers to the gold price. The US dollar was a main contributor to gold price weakness in the previous cycle. And the US dollar is very negatively correlated with gold, so it always plays a role. But today, the main driver is real rates. The gold in periods of low real rates or negative real rates, gold responds very favorably. And what we show in this slide, it's periods where real rates have been low or negative, and you can see the strong correlation. We don't see real rates turning positive for the foreseeable future. It's hard to imagine the U.S. Federal Reserve increasing rates anytime soon or ever at this point. And so there is an expectation for negative real rates to remain low or negative, which we feel will continue to drive gold higher. Another point we often get asked on drivers of the gold price are supply and demand dynamics. Here I'm showing something that relates to supply. It shows the number of larger discoveries that have occurred in recent history. And what we want to show is that despite significant spending by the miners, there haven't been a lot of large gold deposits discovered. these companies are producing gold in excess of what they're able to discover and bring online. So what this suggests is that gold supply, gold production, is probably at a peak and likely to decline in the future. At best, we see production being able to producers being able to sustain production, but we don't expect any significant increases in gold production, which is obviously bullish for gold. In the next slide, we talk on the demand side. And what's important to remember when you're talking about gold, it's not your typical commodity that just relates to industrial demand or physical demand. Gold responds, the demand part of gold that is important is investment demand. And this slide shows the flows into the gold bullion ETFs. And you see how that's reached all-time highs. So this is what's driving gold higher in this environment. It's investors deciding that it's time to take an allocation in gold as a safe haven, as a diversifier, as a protection of wealth. In this slide, we want to highlight how under-owned, if you might, gold is as an asset class. Very little, 0.7% or so of global assets under management are held in gold. And so what this suggests is that even a small increase in this percentage can have dramatic positive consequences for the gold price. And in talking to investors, funds, pension funds, institutions, endowments in the recent weeks and months, what's become apparent is that gold is starting to be considered a longer-term part of a portfolio, not just an in and out hedge fundy tactical allocation, but instead a part of an asset that should be in your portfolio longer term to get you through times like we're going through today. Here we have what central banks are doing. This is again on the, I guess, demand side. Central banks have been net buyers of gold in the recent history for, I guess, the last 8 or so years or more. They used, at times they had been net sellers, but that hasn't been the case in a long time. There's obviously a big focus in diversifying away from the US dollar as a reserve asset, and that has been positive for gold. The China, Russia, India, as highlighted there, Turkey and other emerging markets have been the big buyers in recent years, wanting to increase reserve. China's portion of gold reserves still a very small percentage of total global reserves. So again, them going from 2, whatever the percentage is, 3% of gold reserve to even just a percent higher could have material positive impact in the gold price. Here we talk about central banks again, but highlighting just how balance sheets have exploded globally, something that historically has favored gold prices. Obviously, all the liquidity that has been injected into the economy, we expect eventually to have some unintended consequences, to lead to high inflation, to have created asset bubbles, all of which create systemic financial risk that we believe will continue to be positive for gold longer term. This is, I won't spend too much time on it. It's pretty self-explanatory, but it shows something that not everybody is aware of. Gold has outperformed significantly over the last 20 years or so. So it has done what it sets it to do as a diversification and hedging tool for your portfolio. And here, this is a nice one. Again, I won't spend too much time on it. It's pretty clear. Gold is the navy blue line. And we chose a few periods there where it might be considered a critical crisis, the global financial crisis and other periods of high levels of risk in the financial system. And the most recent, of course, COVID crisis, if you might. But it just highlights how gold reacts in periods as we're having today. And now we'll get to my favorite probably part of the presentation, which is talking about the gold miners. You know, you can invest in gold, you can also invest in gold miners. Let's start with just looking at where the stocks are from a valuation perspective, and then I'll move into some of the fundamentals. But basically here in this slide, we want to highlight, you know, again, a lot of people ask, miners are up, you know, our fund is up over 50% year to day, you know, have they run their course? And what we want to highlight is that although they have been trading up in the last couple of years, these companies are coming from very depressed, historically low valuation levels. We like to show the price to cash flow because it's a metric that investors are familiar with and like to follow. And you can see there in that slide on the left-hand side that today we're somewhere around 7.5, 8 times price to cash flow, despite recent moves. Obviously, as the gold price moves, so do valuations. So the multiples don't change as much as you might expect. But what we like to compare is first to the multiples that were achieved during the previous, most recent gold bull market, where you see the stocks could trade at even 20 times or more price to cash flow. But on average, you know, in that period that we show there, 2006 through 11, they traded at 15 times multiple to cash flow. And even if you just, you know, get the average for the entire period from 2006 to today, you can see that that multiple is still 11 times. So the main point we want to make is at 8 times, there's still room for these companies to trade much higher. And even if you don't think they'll ever get to that 15 and 20 time multiples, there's clearly room for multiple expansions from here. And on the right hand side, we just show again valuations at price to NAV, which is actually a metric that we prefer because these companies have long-term horizons of production. And we highlight the difference between the juniors, mid-tiers, and seniors as our valuation, showing that the juniors have really been even more oversold during the last bear market than the other larger companies. But we see how it's picking up a bit now in recent months, catching up and closing that valuation gap. On the next slide, we talk about really leverage. The reason when the gold price is up 1%, 2%, the stocks trade 3, 4, 5%. And you might wonder, well, you know, why is that? Why are the stocks so much if the gold only moves, you know, a percentage or two? And this is all, it's all about margins. And so what we show on the left-hand side is costs. Obviously, for margins to expand as costs as the gold price increases, you need costs to be contained to really realize that margin expansion. And what we're seeing is that costs are pretty well contained in that $900 to $950 level. And we expect that to be the case. The miners have been very focused in launching initiatives and putting a lot of effort in reducing and containing costs. On the right-hand side, this is sort of the key to the whole leverage story. You know, we showed 3 bars there, and going from 1,800, that recent move from 1,800 to call it $2,000 per ounce in the gold price. That's only a 10 plus 11% move in the gold price, but it results in an almost 30% move in free cash flow. This is money printing. And so you can see why the stocks trade at the multiples they trade relative to gold prices. And so the gold, I want to emphasize that the gold mining story, it's a large part of our bullish case for gold miners is because gold prices are rising, but also because of the state of the sector, the good financial and operational health of these companies. The next slide goes into that financial health that I'm referring to. We happen to just show balance sheets. In the past, those balance sheets didn't look quite as good and healthy. It became very topical, obviously, through the pandemic. how these balance sheets look. And basically, the companies are in great financial health. They have, a lot of them have cash in excess of debt. The trend continues to be for companies to reduce debt. So this is another reason why we're comfortable with a mining investment. I want to take a few minutes here to briefly talk about the gold mining industry and how it has been materially transformed over recent years. During the last gold bull market, at the end of that last gold bull market, companies were chasing growth at no cost, basically, getting larger for the sake of getting larger without really focusing on margin expansions. And that caught up with them. They destroyed a lot of value. They made a lot of poor acquisitions. Capital allocation was poor, and obviously they were penalized for that. And so they've come out of the penalty box. They've done the right things. Like I said, there's been an increased focus in bringing costs down. And so these companies are really profitable now, not just at $2,000 gold, but even at $1,100 and $1,200 gold. They are profitable, and they're producing cash. What's important too is what they're doing with this cash. And in this environment, they're not just going to buy things and make acquisitions at any cost. They're being very disciplined. This cash is going back to shareholders in the form of dividends. So dividend yields across the sector are increasing. This cash is going to repay debt. As I mentioned, a lot of companies are focusing having cash in excess of debt to preserve liquidity and have that financial strength. And it's going to fund lower risk organic growth projects. That's not to say they're not buying and selling assets, but there is a preference to develop projects and to grow their organic pipeline instead of just going to buy new assets. And so we see all this as very encouraging and supportive of the gold mining sector. And again, this combined with rising gold prices is what makes our very bullish case for gold equities as an asset class. The next slide sort of reinforces this. This is very topical. I'm sure it is in Chile as well. There's a renewed focus on environmental, social, and governance issues. It has always been part of our process, in our evaluation process and due diligence of these companies. It's a huge part of gold companies. It can take a decade or more to develop a gold project and for it to become a mine, not just because you have to drill it and prove that the gold is there and make sure it's economic, but because there's so many regulatory, governmental hurdles that companies have to, environmental hurdles, permitting and such that companies have to overcome. And so these companies do all the work. They know how they're going to rehabilitate their mines, how they're going to close them, what kind of environmental impact they're having, and they put actions in place to offset those impacts. All of that has to be done before even an ounce of gold comes out of the ground. And I think companies in the past haven't been as good in communicating this to the market, and they sort of enjoy, I think, a bad reputation. But the work is being done. I think the companies are getting much better now in publishing those results, putting out reports that contain all these metrics. And so I just wanted to bring that up and mention that it is actually another reason to own the miners, the great job they do on the environmental and social side. With that, I think we've come to the period of questions and answers, and I'll hand it over to Carlos from here.
Thank you, Imaro. Definitely is a lot of information here, and thank you very much for all this you have shared with us. So we have a couple of questions here from the audience, and the first one is, Regarding the allocation, and you know, you talk and you get through us to the bullion of gold and gold miners. So thinking about the allocation within, you know, different products, what is your view in the right size between all different products and between the bullion and gold miners?
Now, that's a really good question. One that we get asked a lot. I have a slide here on, let me show you this slide here on the role that gold plays in a portfolio. I think it is important to show how gold as an asset class certainly should have a place in your portfolio. It just shows how little correlation not just gold bullion but gold miners have with basically every other asset class. So in times where things are not working out somewhere else, gold will offer you that protection and that hedge. So that as basically why you should have gold in your portfolio. As far as size, another question we get asked a lot, we think to really have an impact, it obviously depends on your risk tolerance, but you know, if you add 1% of your portfolio to gold, will that really move the needle? We're not so sure. We think somewhere between 3 and 5, let's say 5%, you start to really see the benefits of owning gold in the portfolio. So I would say that, you know, 5 is the middle, that range between 3 and 7 is where funds and investors should consider putting an allocation to gold. As far as, I have another good slide here on gold bullion versus gold miners. In our fund, we can own, in our active fund, we can own both products, and we use what we can use a portion to gold bullion in different times. What's important to remember is that in a rising gold price environment, gold miners will tend to outperform the metal. And I explained the leverage part of it earlier, and that's the reason. The opposite is true. In a declining gold price environment, the metal will outperform the miners. And so once you form a view of where you think gold prices are going, clearly we think they're going up from here, then you can make a decision as to whether you want more or less gold miners push. We think it probably is a good idea to have both. This slide here just shows what happens. Yes, gold miners will give you higher returns, but they're also more volatile, more risky investments. So I don't know if 50-50 is the perfect combination, but you can see clearly what happens to your volatility and returns when you have that mix. And so looking at this, you can see how, you know, each investor has to make a decision of what they're comfortable owning in that mix. But we do think a mix is a combination of both is appropriate, and that 5% range starts to make a difference.
Thank you, Imaru. You mentioned before all the different instruments VanEck has, the active management and the ETF. So if you can discuss a little bit on what is the way that you walk through in the active and versus passive strategy to get access to gold, please.
Yeah, thank you. So at VanEck, we have three really strategies for gold. We have for owning gold miners. We have the active fund that I manage, the International Investors Gold Fund. It's an actively managed fund. We pick the stocks. It's completely index agnostic. And then we have our two vehicles, the VanEck Gold Miners ETF, GDX, and the VanEck Vectors Junior Gold Miners ETF, which is GDXJ. You can also see how a big portion of the assets of the firm, almost 16 billion in the GDX and another 5 in the GDXJ. Our fund is about $1 billion, the active fund. So when I get asked, I'm obviously biased for the active fund, but I think performance speaks for itself. We have historically outperformed the index. I think, the index makes an allocation, the indexed products make an allocation to these companies purely based on market cap. When you think about the nature of this sector, it almost seems impossible to be able to do that successfully given the nature of the sector, the risks that are involved. So we think, and luckily our performance proves it, that stock selection is key in this sector. I have a slide here where we mention, we talk about the team, and I think something I like to highlight as I talk about stock picking and stock selection is the strength of our team. Joe and I both have technical backgrounds. Joe is a geologist, which obviously it's key in selecting stocks in this sector. It's key specifically in being able to have an allocation to junior companies, developing companies, which basically don't have any mine in production but are developing an asset. And that's where Joe's expertise becomes key. Obviously, the earlier you can find these opportunities, the more returns you're going to realize. So I'd like to highlight that strength of the team. I also have a technical background. I'm a mechanical engineer by education, spent some years working in the resource industry with a lot of operational experience in old rigs, etc. So that's also key to the work we do on the ground, being able to understand the engineering aspects of these projects, metallurgically, geologically, structurally, and operationally. So I like to highlight the strength of our team and how differentiated it is relative to our peers.
Thank you, Meru. Another question, and I think one is maybe the most, I don't know if it's important, but it's more relevant so far, is what is the, we have seen the pike of prices, and there you have. What is your longer terms on the price? What is the outlook of this metal?
So we are very bullish, which probably doesn't surprise you, but we've actually, for the first time, I think since I've been on the firm, come out and publish a gold price target. And get ready for it. We have a $3,400 gold price target. Like I said, gold is trading in that newfound range. During a couple of weeks, we had a pretty decent pullback from the 2070 level down almost $100 to 1900. But it's basically holding in that range. You wonder how we came up with a $3,400 target. A lot of technical sort of analysis went into it. But basically, this slide here shows, where we kind of could still go. And you can see from there, if we were to move up, 3,400 is, not even double where we're now, a little less than 100% increase. So you get, when you look at what gold did in these other global markets, you can see how 3,400 seems like an achievable target. People also ask on timing. Personally, I don't think we're gonna get to 3,400 in the next 6 months. I'd be very happy actually to see gold hold that $1,900, $2,000 range for a while. And I think that's sort of my personal target for the next 6 months. It's range bound in that 1,900, 2,000 level. So that 3,400, I think, is more of a longer term 2 to 3 year target, but definitely showing the upside potential from here.
Excellent, thank you, Meru. Regarding how the price affect the profitability of the stocks, do you have a measure on how the price and affect the returns, the profitability that you are facing on the ETF or the gold miners more specifically?
Yeah, and I don't want to confuse anybody, but I do want to go back to this slide on precisely what you're talking about. this is key here to this discussion. Like I mentioned here, as the gold price increases, so do margins. That's pretty obvious. A lot of investors are concerned with what happens if gold price declines from here, and I'm stuck holding this miners, I guess. And in a few years ago, 5-6 years ago, we would have been very concerned of declining gold prices because these costs were elevated. But in today's environment, clearly, if gold prices start to drop from here, or start to get on a downside trend, that's going to be negative for the miners. But as far as profitability, which I think it was the question was referring to, basically as long as gold is above 1,000, 1,100, these companies are breaking even. I think break even, the chart I show here excludes some non-production costs, but at 1,100, basically these companies break even, and any price above that, they're profitable. And obviously this is on average. There's higher cost mines and lower cost mines, but on average, that's sort of where the industry is at.
Great. Regarding what are the difference between investors? What are the thinking about those investors that are more tactical? They prefer more tactical views rather than the other ones that look for long term. What are could be your suggestion in terms of the type of access on the whole ETFs, the volume? What is your thoughts on that regards?
Yeah, that's a good question. As much as obviously I'm proactive strategy, our fund is a sort of a longer, I think, term allocation to gold for investors. If investors are looking for tactical allocations to gold, where they're going to be paying attention to these trends and shift positioning based on what's happening in the next 3 to 6 months versus what's happening in the next 5 years, I think the ETF is the right product. Gold bullion ETFs as well as gold mining ETFs are very liquid, very tradable. They allow that a more tactical positioning, I think, for investors. And so that that would be the preferred vehicle for that sort of allocation.
But regarding the reserve, we have one question here from the audience, which is wondering if there's any ETF that has some reserve in gold, actually, and do you see any type of political risk on having those reserve getting capped by government, or all the political instability creates some noise in this industry? What is your view in terms of how those turbulence in the political side and cycle and can affect the reserve some ETFs could have?
Yeah, no, that's often we hear about investor concern about gold ETFs. Gold is such a key and desirable asset historically and globally, that there's always this fear that it could be targeted by governments, etc. And I guess it did in the past here in the U.S. So I think what the question is referring to is in the case of gold bullion backed ETFs, they have the gold stored in vaults, and there's always been speculation as to whether that gold is truly there, but I think it is safe to assume and trust that gold is there. It is audited, so when you buy the gold ETF, there should be a purchase of physical gold to back, and that's why they're called gold-backed ETFs. Now, is there a risk that we've heard that a couple of times, that all of a sudden that gold in the vaults backing your product could be at risk? I suppose there's always a risk. I see it as very little risk of that. I don't see governments in today's world and rule of law being able to basically confiscate gold in such manner. So I think investors should feel comfortable holding the ETF. It's easy, it's liquid, you don't have to insure it. For those that are not comfortable with that, of course, there's always physical gold that you can own and buy and own and store yourself. Put it in under your mattress, under your pillow. I feel comfortable owning it, but I think there shouldn't be heightened concern about the security of those gold bars that back the bullion ETFs.
And quick comment on what you mentioned, Imaru. Just for the sake of clarity, you don't have, I mean, your ETFs are not backed by real gold, I mean.
Okay, so just for full disclosure, we do have, VanEck does have now a physical gold ETF. It's pretty new. We partner with another shop, and we do offer a product here called Ounce, which is very cute, OUNZ. That is physically backed. In fact, you can take deliverable of the gold. To answer that other question, if you feel like, you know, you got that gold there, you know it's there, and you say, you know what, I don't want the ETF anymore. Send me my gold for a fee, obviously. The gold can be delivered to you. But, so that's Ounce. On our, in the internet, clearly not in the ETFs. Those are full-on gold bullion. So they just hold stock of the companies, the underlying companies. In the case of the International Investors Gold Fund, when we do decide to make a gold bullion allocation, which is in environments where we want to be more defensive, our fund can hold up to 25% of its assets in gold bullion. And in that case, we would have the gold stored in a bank's vault, physically held for us.
Thank you, Mario. I think we have one more question, maybe for the audience, that is, you know, to get a little bit a sense of how can they access to this instrument. So I will switch to Spanish. If I have a question for Carles. Carles, as we are seeing here, como hemos visto acá, VanEck presenta una gran cantidad de oportunidades para tener acceso al oro. Si tú nos pudieras contar en términos prácticos cuáles son esas oportunidades y cómo pudieran acceder a ellas, por favor.
Gracias, José Antonio. Como ya Isma comentó, existen varios ETFs que administra VanEck, la mayoría que se exponen a mineras de oro. Durante la presentación mencionó a dos, uno que es el GDX y otro que es el GDXJ. Esos son ETF pasivos que invierten en estas mineras, uno en mineras de large cap y el GDXJ son mineras small caps. Estos dos ETFs se pueden acceder están listados en la Bolsa de Comercio de Santiago y se pueden comprar llamando a cualquier corredor de bolsa. Y por otro lado también, obviamente, estos ETF junto con otros ETFs que, por ejemplo, IMA administra y hace una inversión activa, como es el caso del IIG, se pueden acceder a través de cualquier plataforma internacional o a través de algún broker internacional. En el caso de Vice, se puede hacer a través del ejecutivo, a través de Pershing, con una cuenta Pershing. Así que eso sería cómo se puede acceder.
Muchas gracias. Y Maru, yo te quisiera pedir si puedes colocar en la última lámina de la presentación. Con esto estamos finalizando este webinar del día de hoy. En términos de Vice, esperamos que haya sido de su agrado, interés. Esto es una materia que obviamente se está conversando. Es un tema de bastante interés, así lo hemos visto nosotros de conversaciones con nuestros clientes. Solo nos resta agradecerles por su participación y asistencia a este webinar. Pedirles si en ese proceso, como dijo Carlos al principio, nos pueden ayudar a mejorar nuestros contenidos y productos de estos webinars, se pueden responder esa encuesta. Y con esto finalizo agradeciendo su participación. Como ustedes saben, en Vice los invitaremos a otro webinar. Tenemos una gran cantidad de contenido. Esperamos que lo hayan disfrutado y esperamos ponernos en contacto prontamente con ustedes. Muchas gracias.